Today, what's on the credit cards really counts. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and proper news with a distinctively Australian flavour. Today, I'm joined by Steve from Canstar. Hi, Steve.
Hi, Martin.
How are you going?
I'm terrific, thank you. Dry, finally.
Yeah, good to hear. And I hope you weren't too severely affected by the Brisbane floods, but it's pretty widespread.
No snorkeling about this time, but
good to hear.
Very moderate effect.
Well, talking about being underwater, I wanted to spend some time with you today talking about credit cards, because there's some interesting things that we should be talking about, and I think a lot of consumers probably need to know. And a good place to start, I think, is, well, what are the latest trends? The RBA publishes data on credit cards, so let's start there. What's the trends on credit card use, and particularly on revolving credit?
Yeah, look, the trend for right through COVID, credit card balances came down, and they came down very, very quickly during the period where we had that early release from superannuation. And there's no question that a lot of superannuation money that came out early went into credit cards. Now, that might make sense for people because credit cards put them under a lot of pressure, but they have to make sure they don't redraw the credit card having diminished their retirement savings. That's the main issue. Now, during 2021, we saw the pace of that decline slow up a bit. We didn't see quite the same pace of reduction that we saw. People knocked about $10 billion off credit cards in 2020. 2021, it slowed up and they were knocking a couple of $100 million off here and there through the year. But we have now seen in the last couple of months, nothing virtually happened a month ago. And in the latest month, which was January, the balances are paying interest on credit cards actually went up again. So we've seen, and this is seasonally adjusted. So don't say, look, this is Christmas. It's got nothing to do with Christmas because it's seasonally adjusted. So we've seen it bounce up again. And we've seen spending on cards go up when it was down during the height of COVID. Obviously, you couldn't spend your money. You couldn't go out. You were much more restricted. So you saved it and knocked it off credit card debt and didn't put new debt on. But that also has changed. Now we're seeing more money being spent on cards, more money staying on balances. So people have to say, look, we've got a little warning bell now. Let's step in before we lose control.
Yeah, and it's worth just talking about how people use credit cards, because not everybody uses credit cards the same way, right? There are some people that are transactors on credit cards. In other words, they use their credit cards perhaps because they can accumulate points, but they then pay off the balance every month. Right? There are also some people who are occasional revolvers. In other words, they will use their credit cards to smooth out some of the balances over the few months, but will pay it down and pay it off. And then you've got hardcore revolvers, which essentially are sitting there with a pile of debt, and they might pay a little bit down, but they're always drawing it off again, which means that those balances are accumulating interest very, very consistently. And it's also worth highlighting the other factor that when you start using a credit card and you actually pay it off every month, you don't pay interest, right? But if you start essentially revolving, interest starts accruing, and interest will continue to accrue until such time as the debt is completely removed. And again, I'm not sure that people understand. So the characteristics and how you use the cards is pretty important.
Look, it absolutely is. Credit cards are designed in theory for people who want the transactional convenience, because credit cards really preceded the full service debit card. So it's convenient to transact on a credit card. And secondly, to smooth out your budget, as you point out. So to take on purchases that you might repay in a few months. A big lumpy thing like a new fridge, rather than having to pay all of the cash up front, you have a few months to pay it on. But they're not designed, should never have been designed for longer term debt, because they're too expensive. You're just paying too high an interest rate for debt on credit cards. We'll look at that later. So people should not be putting long-term debt on credit cards. They should be finding another way. Personal loans are a better way because you're not tempted to redraw all the time. And the problem with debt and high interest rates is that every time you make a payment, a big bit of it goes to the bank in interest, and you're only knocking off a much smaller amount of the principal. Whereas if you're on a personal loan around 10% rather than a credit card around 70%, you'll be paying a lot less to the bank in every repayment you make. So for that long-term debt, get it off your credit card into a personal loan with regular repayments so that you have the discipline. Don't leave it paying that high interest rate. But if you do that, don't keep using a card. Get rid of the card and go to a debit card.
Right. And of course, it's very important to understand that whilst on the statements, they give you the minimum required repayment, right? If you only make the minimum required payment every month, you go nowhere.
Yeah, they're obliged these days to make sure that you eventually do repay the debt, setting a minimum. But the minimum, when they first kind of came out, was about 2.5% of the balance. And it meant that you would never actually repay the debt. It was a perpetual debt. So you can't do that. Don't be tempted by that. The best way to look at it, if you have some hardcore debt, is to say, look, I want to repay this over 2 years. Divide the balance by 2 years and say, all right, well, that's a good start. I'll still have some interest paid that accrues, but at least I'm getting kind of on track to repay it. But there are better ways, and I'm sure we'll talk about balance transfer at some stage. But it is a trap. There's no question. A whole generation of us got caught in a trap. 2 generations, actually. Baby boomers and Gen Xers all got caught in the credit card trap. So millennials, don't fall for it, and don't fall for an afterpay. A buy no pay later style trap either. Debt traps, spending money you don't have, is a trap.
By definition, it's a trap. And the problem is, of course, as we've said on a few other occasions, the financial industry is based on the idea that you're a cash flow and you'll go on paying and paying and paying and paying and paying and paying. That's all they care about, actually. So providing that you make those minimum servicing repayments, or if you're in a buy now, pay later, you're paying the agreed payments, they'll be happy for you to go on as long as you ever want to, right? But it's for their benefit. It's not necessarily for your benefit, is it?
No, that's right. That's right. It's not for the benefit. I'll tell you who the best credit card customer of all time for the banks is somebody who has a lot of debt they're carrying, $10,000, $15,000 they're carrying on their card perpetually. They make their repayments every single month, never miss a repayment, but they carry that debt, and they're using the wrong style of card. They're using a rewards card instead of a non-rewards card, which means they're paying on average 6% more than they need to be or should be. So they're a great customer because there's no default. The bank gets their money back eventually, or maybe never, but if they're going to wait for someone's will. But they get repaid, and they're earning an extraordinary return on the money.
Right. Well, let's just get on to the interest rate discussion, right? Because we know that the RBA cash rate is 0.1%. We know that the mortgage rates have been very low, although they're moving up a little bit, fixed rates. Yeah. But what's happened to credit card rates?
Oh, yes. Now, that's a good one. I'll go back even a little bit further. In October 2009, so that's a real history lesson, the Reserve Bank started increasing interest rates, the cash rate, and they increased by 1.75 over a couple of years, over a year actually, and the home loan rates went up by about the same, and the average credit card rate went up by about the same. Ever since then, though, since 2011, it's been downward. Cash rate has gone down, and the Reserve Bank cash rate has gone down over that 11-year period by 4.65%. So, way down to 0.10%. Home loans kind of followed. They're on average down by 4.09. And at the real pointy end, where people are competing hard, a lot more than that, and a lot more than the Reserve Bank cash rate as well. On average, credit cards went down by, and here's the drum roll, Martin, on average by 0.78%. So Reserve Bank down by 4.65, and the cash rate, the credit card rate down by 0.78. This is the personal cards and the purchase rate. So you can see that there's been very little joy, even though the Reserve Bank keeps cutting, even though the home loans keep cutting. There's been very little joy for credit card holders who are carrying debt. So it says, look, don't wait for the bank to actually reduce your interest rate, and don't expect that they'll fix it for you. You've got to fix it yourself.
Yeah, and if you actually do the maths, the total balance is outstanding on credit cards, and the total interest that the banks generate has become a larger proportion of banks' profits by definition.
It has. Yeah. That's right. And look, the balance is paying interest have more or less halved. So that's really hurt the banks. So they haven't actually over that period thought it a good idea to lower rates. So they want to keep the portfolio nice and profitable. And even though they're getting the cash from a smaller group of people. So if you're one of that group, get out there and start repaying it. Find a way.
Right. And the other point there, of course, is the different types of credit cards are better tailored to different usage patterns. So, for example, if you are a transactor and you like collecting points, you won't worry too much if the interest rate on that credit card is quite a lot higher. Whereas if you are actually a revolver, even an occasional revolver, the interest rate you end up paying and the amount of interest that you actually pay will much more swamp than anything else that you might do.
Yeah, that's right. Look, the rewards cards, non-rewards cards differ dramatically. A 6% difference between the average rate. Rewards cards are great for somebody who repays on time every time, and they're just a nice little bonus. It's costing you nothing. So it's a great bonus. You're not a great customer to the bank, frankly. They're earning interchange income on that, and I'll talk about that if we have time, but they're earning interchange income, but they're not earning anything else. So they're carrying a cost for the card, but they're not earning much on it. But non-rewards cards, you don't get that benefit. But the average is 6% less, and you can get deals way down to 7.49%. So it's the first and most simple way to fix your problem. If you're a good enough customer to be making your repayments, you get onto a lower card if you're carrying a lower interest rate card if you're carrying debt. And again, you've got to keep your repayments up and well above the minimum. Credit cards were never meant to be carrying debt for years, but they are, unfortunately.
Now let's talk about cash withdrawals on credit cards, because this is something else. Sometimes people will need to grab some cash and the credit card's easy, handy, but there are some catches there too, aren't there?
Yeah, there are, Martin. And I think people have to sort of do a bit of planning, even if you're in the position of needing to use credit cards to get by. So you do have to carry some debt. You do need some debt. You got to be careful about doing it by a cash advance, and that's where you go to the ATM or go online these days and actually get the cash directly from the bank and then spend it. The problem with it is that you're paying on average 2.41% more for a cash advance than you'll pay for a purchase you make. So if you're in the unfortunate position for a period of time, for whatever reasons, need to rely upon credit card debt, plan it so that you're using the card for purchases rather than having to take a cash advance, and at least save yourself 2.41%. You'll still be paying too much, but you don't want to do it that way. It's just, and that 2.41% becomes perpetual on the element of the debt that is still cash advance. A good thing happened some years back where government legislated that your repayment had to go towards the highest cost debt. So you will knock off the cash advance debt earlier, but you don't want to let it run for too long at 2.41% more than your purchase rate.
Yeah, and even if you're not currently in debt on your credit card and you make a cash withdrawal or cash advance on the credit card, interest starts accruing from day one, so you don't get any credit-free period.
And on the whole balance. So, you're blowing that whole balance. In fact, even if, with a credit card, even if you miss a payment because you forgot to pay it, then suddenly you started the clock on paying interest on the whole debt right from the get-go. So you've actually got to turn around and clear the whole debt to start the clock on the interest-free period again. So you've got to be careful about how you use these things. You set up a direct debit so that you don't miss it inadvertently, because we've all on occasions been on holidays or something, or just too busy and forgot.
Yes, and in the good old days of paper statements, occasionally the statement didn't arrive in the post and you forgot, and then suddenly a month later you get pinged. What I would say is it is worth making a fuss, and if you're a good customer, they might actually forgive it, but they won't do it regularly, right? If you consistently do it.
Look, we've done it. We have been forgiven, but would you do it every once a year, twice a year, and expect to be? No. Of course not.
Yeah, that's a one-off thing. Now, the other thing I think we should talk about here is the good old balance transfer. In other words, the offers of moving your credit card debt from one provider to another provider, ideally closing the old account and moving it to a new one, although we might talk in a second about the proliferation of multiple cards that plenty of people have. But there are some traps for the unwary, again, with balance transfers, aren't there?
Yeah, I love balance transfers, and used the right way, just like credit cards across the board, used the right way. Balance transfers are a great way to get yourself out of debt. And the reason they're a great way is that the better balance transfer offers have a zero interest rate, and you'll have that for 30 to 36 months on the better cards. Now, that means that when you make your repayments to the card, it's all going towards reducing the debt. So it's a huge benefit. There's not 20% being skimmed off to pay the bank interest. 100% goes to repay the debt. Now, that's with the provisos, and this is where the traps are. That's with the proviso that you're not spending too much on the card. Now, if you put $5,000 into a balance transfer, try to get rid of it over a couple of years, and you start repaying. That's about $400 a month, $200 a month over 2 years will basically knock that off. But if you're spending $200 on purchases, well, it won't. You'll actually end up in the same position you were 2 years ago. So all of your $200 will go towards the purchases, nothing towards reducing the debt, and you'll still be left with $500 to $5,000 worth of debt at the end of 2 years. And it won't be zero. It will suddenly go to an interest rate of around 20, 21, 22% in most cards. Now, this is a huge interest rate, and suddenly you'll be spending, your repayments will be going 20% to the bank for interest, and you'll be back on the debt trap. So when you take out balance transfer, you stop using the card altogether and say, forget about that. You divide the balance by the 36 months of the balance transfer, set up a direct debit for that amount, and at the end of the couple of years, the 3 years, you'll find that it's gone, it's cleared. But the trick is not to use the card. The other thing is don't be dazzled by the big zero, because some balance transfers have fees. Some have an annual fee and some have a fee up front the minute you transfer the money in. So, that might be about 2% or something. So it means that if you're transferring $1,000 in, then in fact your debt is suddenly $1,020. So don't be dazzled just by the zero. Look at the fees as well.
Yeah, very good advice there, Steve. And the number of times that I see people taking advantage of balance transfers and then tripping up because they forget the critical rule that it doesn't go on forever, right? At some point, suddenly that interest rate really, really jumps.
Yeah, it does. And the thing about balance transfer is that it's repayment discipline that you need to put in place, and it's also spending discipline you've got to put in place. So you have to spend less. It's spending that got you into this position. You've got to stop spending to get out of it.
Now, let's just talk about having multiple cards, because certainly in my surveys, I see households who are particularly in financial stress accumulating a portfolio of cards, right? And trying to juggle one card, the next card, the next card, and then they'll get another new card. And whilst the official view is, well, the credit score and, the credit ratings agencies should be aware of this and should effectively make it harder to get more cards, in practice, a lot of people end up with a whole portfolio of cards.
Yeah, they do, Martin, and I don't know how they balance them. It's sort of like shuffling a deck of cards. And which card do I use for this one? It's repayment due, and sort of rolling debt from one card to the other because you can't even afford the minimum repayment. None of it works. It's just a nightmare, and it's so stressful for people. It puts them into an awful, awful situation. The best approach is to, if you're in that position, the best approach for most people, provided they're creditworthy still, because this multiple credit cards is going to hurt your credit rating. And I'll talk about the limit in a minute. But provided you can actually get credit still, the best answer if you're in that situation is to just consolidate it all onto a personal loan at a much lower interest rate, 7 or 8%, 10%, and get it into one place that has the discipline of a repayment that's fixed for every single month, and then get rid of the cards. Put them, get rid of the ones you've closed off, get rid of the whole lot, and don't take another card because it's the discipline, the lack of discipline that got you here, and you just can't keep living that way. Personal loans are lower cost, they have the repayment, and you just have to bite the bullet and say, credit cards are not for me. Now, I know this is easy stuff to say, and a lot of people can't do it right now because they might have lost jobs, or they might have other costs, and they might have been flooded, and all these things happen. So I know that people can't always follow the advice right now, but store it up so that when the time comes, you say, right, now I'm getting under control again, and I've got to get rid of this. I don't want to be in this position next time I hit a crisis.
Absolutely. Well, I have in my hand one of the best financial management tools in the world, right?
Yeah.
Sometimes the only answer is to cut the card up and stop using it. And I know that's a really painful thing to say to people, but generally, this is probably the best advice,
And trust Martin, believe him, because Martin's a fearsome character with scissors.
Well, I'm not saying you should never get credit and never use credit, right? But what I see in my surveys again and again and again is people effectively get themselves in too deep, and then the natural reaction is to reach for more credit, right? Yeah. And to try and keep the dance up a bit longer and hoping that it'll magically shake itself out, right? If it's a behavioural driven situation that you're in, and almost always is, you're spending too much relative to your income, unless you change your behaviour, you're never going to get out of the pain. And like I said, the banks don't care as long as you go on shelling out and paying them interest, right? They don't really care. So it's really important to get a bit of discipline in place and take those hard decisions. I know it's tough, but it really is the only answer.
It is. It absolutely is. And you start with your own budget and you say, look, money in, money out that must go out to pay the bills and to pay for the groceries and food on the table and petrol in the car. And then say, all right, what am I left with? Now, if you're not left with enough at that point, then you are in some difficulty and you probably need to get some counselling, but don't pay for counselling. Go to one of the government ones. Yeah. But most people will find they do have something left at the end of that. If they're in work, they have something left, and that's the amount that you can spend on discretionary stuff, on the things you'd like to do if you could afford it. the going out to dinner, the entertainment, holidays, all those things. That's how much you've got, but that is all you've got. Credit cards don't provide an answer when you don't have money to spend. Now, I'm a great believer in credit, and think it's a great help to people, provided they get the idea that this is meant to smooth things, not to stay on as a long-term debt. It's just meant to smooth out your budget and pay for some big item that came out of the blue, and you can afford to repay it in a few months, but just not 1 month. That's what credit cards are genuinely designed for. So use them that way, but don't use them for this 2-year kind of event.
Absolutely, yes, they have a place, but you need to be careful, otherwise they can take over. There's one other thing I just wanted to touch on briefly, and that is payments, right? Because a credit card is also, as well as an instrument of credit, it is also a payment vehicle. And it's interesting that you've actually got 2 payment channels, a debit payment channel and a credit payment channel. Now, when you go in and use your card at a merchant, you're not often given the choice that you should be given, right? Which is which channel do you use?
Yeah, you do. And interchange is so tricky. It's such a complex thing. Interchange on credit cards goes, the customer of the bank, the person buying something at the store, uses their credit card. The retailer receives their terminal from a bank, and the retailer pays the bank a merchant services fee, and that bank pays an interchange fee to the bank that issued the plastic to the customer. So it's a little circle there, and interchange is a big cost. Now, it works that way for credit cards, and it works in the opposite direction for debit cards. It does my head in every time I've got to think about that. So for debit cards, the interchange is paid by the plastic issuing bank, the one that issues the card to the customer, through to the retailer's bank. So it's just the opposite direction. Why? Oh, it's historical. Let's not worry about it. I never understand it. Now, the problem is that you're up for different costs with each of them. And the thing you need to know as a consumer is that if you're making a purchase and you're going to be charged by the retailer to compensate them for a high interchange fee, then they have to tell you that. Now, if they tell you that and you say, well, will it be less on this other card? And they say yes, you're better off going to the other card, whether it's a debit card or a lower cost credit card. Now, the reason this is interesting is that, to me, is that the Reserve Bank a couple of years ago changed the interchange rules for credit cards and said, look, we had a cap on this. It didn't quite work. Now we're putting a much more strict cap on it, and that's that. They can't cross-subsidise through their card portfolio. So we're putting a much stricter cap on this, and it meant that the banks, the card issuing banks, the ones that issued the plastic, were receiving less income, and it meant that there was less cost on the acquiring bank, the bank that provided the terminal to the retailer, and less charge from the retailer. Except that Amex is outside the system because it's not a bank. So American Express kept their interchange higher than the other banks, because they're actually going direct to every retailer. So they go direct to the retailer. They cut out the need for the other bank in between. So you might find, if you're using an Amex card, that you'll be asked more often for a surcharge. So if you do have Amex, they actually provide some of the best rewards programs, and they've got a reasonable low rate card as well. So it's a good range of cards for the consumer, but you might be asked to pay a surcharge. And if you're being asked to pay a surcharge, it's a good idea to have in your wallet another card that doesn't have a surcharge. So I know it sounds complex, but all you've got to know as a consumer is that if you're asked for a surcharge, you might want to explore a way to avoid that with either another credit card or a debit card.
Yeah. Again, it is complex, but it's worth understanding because those surcharges can mount up. And the final thing to touch on is, of course, more people now use a virtual credit card, in other words, an electronic wallet or on their phone, attached to their credit or debit card, sometimes via Apple Pay and all sorts of things like that. So this is now another convenient mechanism. Are there any particular traps that people need to be aware of there?
Yeah, when they first came out, there was a surcharge on those, the retailer you bought your coffee from, the coffee shop, was applying, most were applying a bit of a surcharge on those. And it's because the banks were up for an extra cost that Apple was charging them, and they said, gee, we want to recover some of that. So they're up for an extra surcharge. A lot of retailers have stopped doing that now. I think most have, but you can still be asked for a surcharge when you use your phone to make the repayment. So if you are, it doesn't. You can still use your plastic and avoid that. Now it's not as much as some of the surcharges that you might be asked for, with an Amex card, for example, but you don't want to just part with money for nothing, and that's effectively what you're doing. Maybe you still have to carry a plastic sometimes to have the best of all outcomes.
Absolutely. So I think as we come to the end of this exploration of credit cards, I guess the key messages that we want to leave is, firstly, you need to know what the interest rate is on the card that you've got, right?
Yep.
Secondly, you need to understand the type of user of credit cards that you are. Do you revolve? Do you transact? And the third is, think carefully if you are actually in the part of the market where you are continually revolving on credit cards. There are way more better alternatives, and you can pay a lot less. But there is also a behavioural aspect, and of course, it is the behavioural aspect that the credit card companies rely on.
Yeah, it is. It absolutely is. I always say when people are budgeting or choosing a credit card or anything else, know yourself first. And that's exactly what you're saying. Know your own behaviours first and say, well, that is why, that is how I'm choosing a credit card. And if you're someone who does struggle with credit, does struggle with spending, credit cards probably aren't ever going to be for you. So don't even start that journey. But if you're someone who has the capacity to make repayments on time every time, then that's a different situation altogether. Now, the person in one instance should not have a credit card at all. If they already have credit card debt, they should either be going to a low rate interest rate, so somewhere around 11, 10%, but there are some even lower, and repaying as quickly as they can, or even a balance transfer preferably, and we talked about that. If you're someone who repays on time every time, and in particular if you spend quite a bit on your card, then do look for a good rewards card. Good rewards cards are, they're not as good as they used to be, because that interchange hurt the rewards. They cut the rewards back, but there are still some cards out there that provide very good rewards, and it's a reward for nothing. Don't change your spending behaviour, but take a rewards card that actually gives you a good return. That means a return after the cost, because there's normally a couple $100 worth of annual fee. So small spenders on the card won't ever recover a couple of $100 of annual fee. So watch that as well. But they're the people that can take a rewards card, and it's worth doing if you're in that category. It's never worth doing if you're carrying debt. So don't get trapped into paying 22% interest when you're carrying debt just to get rewards. You'll never, ever be ahead of the ledger. The bank will beat you every time. So credit cards, rewards are great for the right person who pays on time every time and spends a fair bit on the card. And if you're not in that category, forget about rewards and go for the lowest interest rate you can find.
Yeah, Steve, well, I appreciate your time today. And as always, we should say that there's lots of information on Canstar's website. You list out all the different credit cards, all the different features, so you can actually go through there and find the one that's right for you. But, start from that behavioural understanding and go from there. And the final message, which I want to leave, particularly now with the cost of living increases and the pressure on households, is be really, really careful about incremental debt creep. In other words, getting more credit cards and just letting the debt roll up, because unfortunately in the current environment, that's a recipe for disaster, isn't it?
It is. And interest rates are going up again pretty soon. We'll see the Reserve Bank cash rate go up, and that will mean existing borrowers have a higher interest rate, and it will probably mean credit card rates go up as well. Now, not necessarily because there are political pressures around this too, but what it means though is that bank repayments and bank debt, whatever form it's in, will become a bigger pressure point for people. So it will get tougher, and if you do have borrowing, so get yourself ready for it and tidy up the house before that comes.
Great advice, Steve. As always, thank you very much, and we'll talk again soon.
Thanks, Martin. Cheers. Good.
Cheers. Bye-bye.